April 5th, 1933, a date almost nobody remembers, but every serious investor should remember it. On that day, President Franklin Roosevelt signed Executive Order 6102. The order made it illegal for American citizens to own monetary gold, hand it into a Federal Reserve Bank within 30 days, and get paid $20.67 per ounce. The penalty for non-compliance? A $10,000 fine, which is roughly equivalent to $240,000 right now, or up to 10 years in prison. So Americans handed in their gold. They had no choice. Then within a year, the government did something extraordinary. It revalued gold at $35 an ounce overnight by decree. And those Americans who had handed in their gold at $20.67 per ounce watched the price climb to $35 an ounce the moment they couldn't own it anymore. The dollar was devalued by 41% in a single stroke. 41% of every American's gold-based savings was effectively confiscated by a stroke of a president's pen. And this is what people forget when they say the state can't take your assets. Of course it can. It just has to be politically convenient. The Rothschilds understood this in 1815, when Napoleon's armies redrew the map of Europe and currencies collapsed across the continent. The Americans were taught it in 1933, the Cypriots learned it again in 2013, when bank deposits over 100,000 euros were confiscated partially overnight to bail out the banking system. 47.5%, that's how much of every large Cypriot deposit was seized. Not in some distant century, not in some failed state, in a member of the European Union, and in the lifetime of nearly everyone watching this video. The lesson keeps repeating. Sovereignty over your assets isn't a libertarian fantasy. It's a recurring historical reality. And Bitcoin's case isn't that the government will come for your assets, it's that history shows that they can. And a small allocation to an asset they cannot reach is what serious wealth has always done. And in this video, we're going to explore that subject. If you enjoy investing videos and want tips, strategies, and insights, subscribe to my channel where I post at least 5 videos a week on those subjects. Now, before the crypto bros in the comments start celebrating, I want to make something clear. This isn't a Bitcoin to $1 million video. This is not a video about getting rich. This is a video about how to hold an asset like this without blowing yourself up. Because most people who own Bitcoin get it wrong. And I want to try to show you what the right case looks like. And let's start with the case for Bitcoin, told through 4 moments that most people probably don't know about or might have forgotten. Cyprus, March 2013. On this small island nation in the Mediterranean, banks closed their doors for nearly 2 weeks. ATM withdrawal limits dropped to 100 euros a day, and when the banks finally did reopen, depositors with more than 100,000 euros discovered that 47.5% of their money had gone. Not borrowed, not frozen, gone and converted into shares of a failing bank that nobody wanted to own. The depositors didn't see it coming. They couldn't move their money out. They couldn't even withdraw their own cash. The state decided over a weekend that their savings would pay for the rescue of the banks that had been holding those savings. In the weeks after Cyprus, the price of Bitcoin doubled. Not because crypto suddenly became more useful, but because for the first time, hundreds of thousands of Europeans understood that money in a bank account isn't your money. It's an IOU from the bank, backed by a government that can change the rules whenever it wants. Next case, Argentina, which is ongoing. The Argentine peso has lost more than 99% of its value against the dollar in the last decade. Inflation has run above 100% per year. Capital controls limit how many dollars an ordinary Argentinian is allowed to buy. The government has frozen savings accounts twice in living memory. In 2001, they trapped depositors with limits of $250 a week and watched as the peso fell 75% of its value while their money sat locked inside the banks. Argentinians don't hold Bitcoin because they read a Substack about monetary policy. They hold it because they have lived monetary policy, and they know exactly what currency debasement feels like. Nigeria, 2024. The Naira loses roughly 70% of its value in 18 months after a forced devaluation. Bitcoin trading volumes on peer-to-peer networks explode, and Nigeria becomes one of the top countries in the world by crypto adoption per capita. The government's response isn't to fix the currency, it's to crack down on the exchanges, arrest the executives, freeze the accounts of people trading the currencies. And the lessons Nigerians took home is the same one the Cypriots took home. When the system fails, the system tries to blame the people trying to opt out. Russia, February 2022, within days of the invasion of Ukraine, half of Russia's $640 billion in foreign reserves held in dollars and euros at Western central banks is frozen. Just frozen. The Russian central bank, an institution that had spent decades stockpiling foreign reserves as the ultimate safety net, discovers that the safety net is held in someone else's house. You can have your own opinions about whether that sanction was justified. That's not the point. The point is what it proved. Even central bank reserves, the most sovereign money in the world, are only sovereign as long as the country holding them on your behalf continues to cooperate. Those are 4 stories from 4 different decades on 4 different continents of 4 different political systems. And it's the same lesson every time. The assets you hold in someone else's system are subject to someone else's rules, which leads us to Bitcoin. But why Bitcoin and why not gold? I'll give you 3 reasons and they all matter. One is it's portable across all borders. Gold is great until you actually have to physically move it. Try walking through customs with a kilogram of gold in your luggage. Try wiring it across a sanctions border. Try fleeing a country with it sewn into your coat. Bitcoin, on the other hand, moves at the speed of light, weightlessly with no border guard to ask permission. And for anyone whose life moves across different jurisdictions, which is a lot of us these days, it really matters. 2, it's verifiably scarce. 21 million units, hand-coded, auditable by anyone with a laptop. Gold's annual supply grows by roughly 1.5% per year. Fiat currency supply grows by whatever the central bank decides it should grow by. Bitcoin supply grows along a fixed schedule that nobody can change without consensus from a global network. That's a different category of scarcity than anything humanity has ever had access to. 3, it's self-custodial. And this is the part that most people skip. Gold is in a vault in someone else's hands. Dollars in a bank are in someone else's hands. Bitcoin held on your own hardware wallet with keys you control is the only financial asset on earth that nobody else can freeze, seize, or override. Those 3 properties, portable, scarce, and self-custodial, are what put Bitcoin in the Rothschild category. Not the price chart, not the speculation, the properties. Now the part that almost nobody on YouTube will tell you. Bitcoin, of course, is volatile and sometimes terrifyingly volatile. The asset has had multiple 70% plus drawdowns in history. If you can't psychologically tolerate watching your position lose 3/4 of its value and still hold the position, then you should not hold this asset in any meaningful size. So here are the rules I follow. Keep it to 1 to 5% portfolio allocation. Anybody telling you to put 50 to 80% of your net worth into Bitcoin is either gambling or selling you something. The next rule is to dollar cost average. Never lump sum at the peak. Bitcoin's history is littered with people who bought at the top of a cycle and then sold in panic at the bottom. The discipline isn't market timing. The discipline is buying a fixed amount on a fixed schedule regardless of price. Every week, every month, boring, mechanical, effective. And one of the largest holders of Bitcoin, Michael Saylor, does exactly that for many decades. Rule 3, self-custody. Holding Bitcoin on an exchange is risky. It's the same kind of problem Cypriots had when they held their money in bank accounts that went down, that got seized. Once you have a meaningful position and amount of meaningful Bitcoin, you should move it to a hardware wallet where it's more in your own control and keep safe backup keys. Rule 4, plan for any large drawdowns, but don't sell at the bottom. Don't day trade it. Don't try and swing trade it or anything like that. If you're going to hold it as an asset, be prepared to hold it through the ups and the downs. And if you want to trim a little bit, try to trim at the top. And that's really it. I just want to close with one more historical lesson. Every generation gets a new asset that the wealthy adopt early, and the public either dismisses as a scam or a fad. Railroads in the 1850s, industrial equities in the 1920s, real estate after the World War, tech equity in the 1990s. In every single case, the same pattern repeats. The first cohort of adopters is laughed at. The mass adopters arrive only after early generational gain has already been made. And the holdouts explain why they didn't and why they missed out. Bitcoin may or not be that asset for our generation. I'm not certain, and anybody who tells you that they are, because we don't really know where it's going to go, right? Those who are certain are probably trying to sell you something. But if you stay disciplined, keep your position small, and manage your risk, then any big drawdown isn't going to hurt you. So keep all of that in mind if you're interested in Bitcoin and holding it as an asset. And if you enjoy this video and look for more long-term investment advice, tips, and insights, subscribe to this channel. I post at least 5 videos a week on those subjects.